Live from Davos, it's Malcolm Ethridge. How's the weather out there? How was meeting the global elite?
I wish I had gotten my invite. I must not be global elite enough.
I want to go one time, and I'm bringing Alex Jones. Other than that, how's your world going?
Upside down, man. Speaking of Davos, like just watching what all is happening, it has been a hell of a week in the markets, and it's all because of public speaking that has been done on behalf of or by the president of the United States. And like, what a roller coaster ride for such a short week, a holiday week. Like, what a heck of a week it's been.
We had the markets forgot Taco. Trump always chickens out. This is on the Greenland thing. Mm-hmm. Then the markets remembered Taco. Then we saw the sort of like longer term storyline of the Sell America trade, where there's now news where like a Danish pension fund is selling their American treasuries, gold and silver, going absolutely wild. So it was interesting. There was this microcosm of very like flittering short-term stories, but also evidence of the real long-term trend that we talk about a lot on this show, because it is maybe the defining economic storyline, I think, for investors and people in America and the world.
Well, I guess that means we got plenty to talk about.
Let's get into it. All right, Malcolm, let's start on a more positive note. Yeah. We did a little geopolitics. We got more geopolitics coming later, but we also, sometimes we buy stocks, and that's one reason people listen to this show. Sure. And I know you've been talking about some of this on CNBC with ServiceNow, some of the big banks. I've got some thoughts on Netflix. Yeah. Don't you worry. But let's start with the big banks, because these are under a little bit of fire. JP Morgan, you have a CEO who's trying to not get the chair of the Federal Reserve job, who's trying to help America privately while publicly, not criticizing the dragon too much. Why are you liking the big banks right now?
Well, partly because, like you said, Jamie Dimon's staying right where he is. I read recently that he was behind the scenes offered the Fed chair position, and he dismissed it as a joke, is the way it was characterized by the Wall Street Journal, even though I'm not convinced that it wasn't said very seriously, and he dismissed it or turned it down very seriously. But this is also a guy who was being floated, 10 years ago. Folks thought he might be trying to make a run for the White House. And so he is obviously very good at playing politician, and he's at this point like an elder statesman on a global stage, not just among the Fortune 500. So definitely worth listening to what he has to say about all of this, but separately to the point you're making about buying the banks. So two things are happening. One, I am not adding new money to the existing Mag 7 stocks that I already own in my own personal portfolio. Instead, new money going into my account is going into the financials, and specifically the big three banks. So JP Morgan, Goldman Sachs, Morgan Stanley, I call the big three. I know that we colloquially refer to the big six. That includes Bank of America, Wells Fargo, and Citi. And those are also referred to as GSIBs, globally significant banking institutions. But I think the big three matter more because they don't rely so much on net interest margin, which is the big metric that tells you how profitable a bank is. The spread between what they take deposits in and pay out interest for versus what they can turn around and lend the money out the back door for. That arbitrage is called their net interest margin, basically. I'm oversimplifying a little, but that's basically what it is.
It's hard to do math on a podcast, or show a formula, I should say.
That doesn't really matter to me. I think that is a very old school way for banks to make their money. It still exists. Like, we all still need to borrow money, but if there's going to be a 10% cap placed on credit card interest rates, that's going to negatively impact all six of those companies. But the IPO market is expected to be extremely hot this year. And the three companies that happen to be attached to just about every single IPO that happened in 2025, 2024, it was either named Morgan or Goldman. And so I think it makes sense to be owning those three banks because the transaction activity on both sides, whether they're buying or selling, the investment banking transactions are what really keeps the lights on at most of those institutions, and also the wealth management divisions underneath the hood, which earn a larger portion based on how the markets are performing. They charge an assets under management fee. It's a percentage of the assets that they manage. So as those assets go up, because the market has been going up and to the right for the last 3 years, their slice of the pie has also gone up proportionally. And that is also what is helping to keep the lights on and ring the register. And so for that reason, it feels to me like right now, those three banks can't lose.
So this, from what I'm hearing, this is not I'm going to hold this forever for 5, 10, 20 years. This is almost sounding more like a cyclical. You are noticing a moment in the cycle that you think will continue for a period of time, but requires maybe a more active monitoring than I trust this founder for 10, 20 years.
I think that's a good way to put it. I don't necessarily love banks as long-term investments, primarily because this moment that I'm talking about comes once a decade for them. Like there is a time when they have their hot girl summer and then it fades. And then you spend the next 9 years, 8 years watching that stock do nothing but pay you a dividend. So if I were a dividend only investor, I would want to own the big banks forever because they pay out some of the largest payouts, but they're burdened by regulatory costs. They're burdened by, all kinds of, they're some of the biggest taxpayers of all of the companies within the Fortune 500. So I'd rather own something else that has the ability to go up and to the right with much larger gross margins, like a tech company. But right now, while tech is sort of taking it on the chin, especially anything attached to the AI trade, this is a better place to me to be allocating new dollars with the potential for a decent level of growth rather than sticking to what's worked the last 3 years.
The other non-financial stock you've been excited about that I don't know much about, actually. This is one that I know it's historically been expensive, and this company does back-end workplace automation for companies, and that's ServiceNow, but that's one you've been hot on. So just as, not really for the listener, but just for me, is I have been in a larger cash position lately. I'm like, I should probably not start looking, but I like the idea of not just sitting on cash forever, especially when there's potentially undervalued opportunities out there.
Yeah, so you're right. This is one I'm like super passionate about at this point, and I'll try my best to make it quick. Essentially,
we're on a podcast right
yeah,
now.
no, but nobody wants to listen to me like ramble on and on about like why I love one specific company. But like right now, what I'm looking at is the software sector at large has been completely obliterated the last year, let's call it, maybe the last 9 months. And a lot of what it is investors are afraid that AI tools are going to come and just completely destroy the moats that have been dug out by a lot of these software companies, especially the ones working in automation, because you can bring in, anything that's built on top of an LLM at this point and create a much cheaper custom automation within a company. And probably do it faster than many of these companies can because you don't have nearly as much legacy construction that you have to untangle and pull apart. So ServiceNow is on the list of companies that people are worried like AI is clearly going to come and take this job away, take this work away, which makes perfect sense. I think it's a perfectly rational concern. I also think for a company that's traded down 40% from its high, the conversation about it being overvalued has gone away. So if you liked it initially when it was trading, out of the stratosphere from a valuation perspective, it has definitely come in a lot, and now you should love it. Separately from that, I'm not as worried about ServiceNow being disrupted in the way that a lot of other companies can and will be. One, because I think that their management team, specifically their CEO, has shown over the last 10 years where they've 10x'd their revenues from 1.3 billion to 13 billion, that they have a way of figuring out how to grow, right? Will they grow at the same rate that they have over the last decade going forward over the next decade? Time will tell. But what I'm looking at is a company that is continuing to grow their bookings, They're continuing to grow their revenues in the double digits. They're continuing to grow their free cash flow, I think 30% plus at their last earnings. So there's a lot of positive markers there that tell you that there is some there. I wanted to own it back when it was overvalued and just could not bring myself to buy a stock that hot. Now I'm looking at it and it's come in a ton. And so I think while it's having this existential crisis, this is a great place to be buying it. Separately from that, one of the things that's making me so sure that the moat that they've dug can continue to keep competitors away is because I don't think that there are very many chief technology officers, chief information officers, chief information security officers at these Fortune 500 companies that ServiceNow has as customers that are going to be willing to sit across from two dudes with a laptop that represent some Silicon Valley startup and implement their software solutions inside of that organization and be willing to stake their entire careers on that decision. So for now, the safer choice, even if it costs you more than you know you have to pay to get these custom automations, is to stick with the incumbent as a large or mid-sized enterprise. And so I think we're overdoing a little bit the concern about these software companies. Salesforce is probably another great example. I don't like Salesforce as much as ServiceNow. Even after its sell-off, I'm not as excited about owning that stock because I do think a decent amount of what they do in the customer relationship management space has been and will continue to be upended by agentic AI. But all that to say, I think the whole sell software trade has been overdone.
I think that's interesting, especially the point that, the narrative we've been hearing is that it's two guys or two people in a garage who are going to upend these large enterprise companies. And there is a human behavior element, which is if you're a high level executive at one of these, the cost of you making a mistake is extreme if you bet in one of these areas. And some of them will break through. I think there will be a lot of maybe consumer things there, or they'll get bought up. It'll be like a biotech type of thing where they'll create a tool that gets bought up by the bigger companies that have that firing powder. But yeah, I'll take a look at that.
And they have been acquiring. So that's part of the story too, where they feel like they're a little weaker and they need to get stronger. They've done a ton of acquisitions, Armis, MoveWorks, Visa, Data World. Like they're buying up companies to get bigger and stronger and incorporate AI tools into their growth story and into their service offering. And there's been recent reporting, I think it was from the Information, about the fact that any new entrants into the space, any entry-level jobs are requiring folks to prove their AI chops as part of the interviewing process. So they are, the whole narrative was AI is not going to steal your job. It's going to be a person who understands and knows how to use AI who's going to steal your job. In this case, that is seemingly true for ServiceNow. Like we're replacing entry-level jobs that would have, 2-3 years ago, AI wouldn't have been a requirement. Now you've got to sit and take an assessment and prove to us that you know how to use AI because we're changing our culture to embrace this technology, not be unseated by it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
I want to talk about Netflix. This one is interesting to me from a storyline perspective, and I now have the company back on my watch list. One of the reasons I sold it a while back was because basically every analyst could not find anything negative to say about the company. This was about a year. I think this was about a year ago. In this latest quarter for Netflix, every single metric seems to be improving. They're getting more profitable. Streaming hours are up. They're still finding millions of subscribers to come onto the platform. And it has now become, for investors, whether or not they think the Warner Brothers Discovery merger is a good idea or a complete change in culture that will lead to, stagnation for the company. And I think there's a good point there, which we've talked about the merger on the show, but I was listening to an analyst, I forget where it was, say every single company basically that has bought Warner Brothers has tried to get rid of it with Time Warner, then Warner Brothers Discovery. So maybe this is, maybe Netflix and Paramount are just bidding up an albatross. But I still look at this and I'm like, this company is dominating. And I think at this point, a lot of analysts are concerned trolling unfairly. There's this one analyst, Jeff Wolderzak, said, quote, "While engagement rose slightly, we are increasingly concerned, especially Gen Z, is less interested in long-form content as their time migrates to free social media platforms." Their engagement rose. They're putting things like long-form podcasts on the platform. And also, I would say, Jeff, Gen Z can look at their phone and watch Netflix at the same time. This is the exact thing that Matt Damon complained about when he was promoting his movie, The Rip, and he was like, "Yeah, when Netflix gives you notes, they tell you to repeat what's going on in the storyline for people on their phone." So that's kind of a cynical perspective, and I hope with HBO content, Warner Brothers content coming on, even with podcasts, they're able to separate more of the casual viewing and serious viewing. But I think when I see this company has gone from a golden child that nobody can find anything wrong with to let's all pile on and beat this thing up. So I think it's in some ways become a bet on Warner Brothers Discovery, but I can't ignore, even though I don't have a position, I cannot ignore that this is a world-class company that's getting beat up on a narrative basis as well.
You're taking the over here. I'm going to take the under.
Go ahead.
To me, this acquisition and their forcefulness or unwillingness to change course, to me, looks like a lack of creativity at the top of this company. So their management team has the ability to look at the same trends that you and I are seeing and more and see that the reason they've been unseated by YouTube is because user-generated content is now king. And instead of, so $100 billion, let's say, is what this thing is going to cost them ultimately, for the sake of round numbers. Instead of spending $20 billion a year on creating new user-generated content, and you know how much user-generated content $20 billion can buy you, because it's very, very low investment to get quality content. Instead of digging in there, you mentioned podcasting, for example, and getting exclusives with podcasts so that they can take those audiences to Netflix and away from YouTube and say the only way you can get it is to log on to Netflix one more time today. Instead of going that route, they're wanting to buy legacy movies that the reason it's being sold in the first place is because nobody wants to log into the HBO app and watch Batman Forever one more time. Like, to me, it looks a lot like we're trying to do the things that have been proven to work time and time again and hoping for one more time, one more hurrah, rather than looking at where the marketplace is going, and being once again a pioneer or a leader in the space and figuring out how to once again conquer and dominate the streaming wars like you're talking about.
So what if they can do both?
This is a giant distraction, though. You can't fight a war on two fronts at the same time. It's the reason that U.S. consumers are paying the tariffs instead of the companies that we were supposed to be crushing with our tariffs, right? You can't fight a multi-front war.
Oh, we'll get to Davos in a second, but I'm not going to do geopolitics quite yet. Even though
but that was a good analogy. You gotta,
a multi-front war. They could. No, this is also, as politicians say too often, walk and chew gum at the same time. They built their live events business. They built their advertising business. They're putting in some, I would say, higher, let's call it the cream of user-generated content. They brought Miss Rachel on, which a lot of young children like watching. They're trying to bring video podcasts on, which I'm a little more mixed about the strategy, just because we've seen Spotify sort of backtrack a little bit.
But imagine
exclusivity.
Imagine for a second if Netflix could take their marketing know-how, their production know-how, their everything else, and pour that into some of the mid-tier podcasts that either do or don't have video, and say, we're going to put you in our studio. You're going to churn out all this content in our studio with our production team. It probably cost them like $2,000 per episode, right? Versus a movie that's going to cost $10 million to produce. And so I just feel like that is where the opportunity is for them. They could, they got Jake Paul already doing a live event fight on the network or on that platform once a year, right? They got his brother doing WWF however many times a month he does it.
WWF?
Sorry, WWE, whatever.
Come on, man.
Well,
you say kayfabe a lot. We gotta update that branding.
I'm old, so it was always WWF to me. But like, imagine putting money into creating more content with the Logan Paul, Jake Paul combo, and and using Netflix's production ability to do, like, that's the crap that people want from Netflix and come to Netflix for. Again, I don't want to watch more Wonder Woman spinoffs. I don't want, like, I could go to HBO and watch that if I wanted to see it. It's no point in you paying tens of billions of dollars to bring it to me here when I could also go there and get it.
I was going to move on, but I'm still ready to debate. Debate me. Facts, not feelings. Prove me wrong of what you're talking about. I think there is a significant difference in what the content people want to watch casually and for free and the content that people are willing to pay for.
Sure.
And I want to give Netflix some credit in trying to find a balance of both, of dishwasher TV and the premium stuff you can't get anywhere else.
Dishwasher TV.
The Jake... It's the TV that's on in the background while you're doing dishes.
That's good. I don't know if you came up with that on your own, but that's good branding.
I wish I came up with that. I didn't.
Okay.
But they still want premium things that you have to pay for and be there for. I guess they're going to try it with the World Baseball Classic. They're doing it with the NFL. There is a significant difference in between those. And they want the eventized things that you get from HBO. HBO, you mentioned a Wonder Woman spinoff. They also have Harry Potter. They also have... Game of Thrones. That's not a one-to-one comparison with YouTube. And that is something where if you like that stuff, you are willing to pay for it and understand exactly why you're paying for it. It is a departure from their branding. However, they've done that before and it has been successful for them, specifically with advertising. We will never do ads on this platform. Then they do, and it's a multi-billion-dollar business. And I wonder too, if Warner Brothers Discovery, this is the 3D chess, if they get it and it's a little bit of a loss for them, but it prevents one of their main competitors, Paramount, Comcast, NBC Universal, from gaining ground on their dominance, is it worth it to take just a little bit of an L as you continue to expand yourself into being the monopoly, one entertainment empire to rule them all?
That's the most logical justification for this battle that we're watching. If the whole goal is I want to keep you from being any more successful than you are today and keep you from encroaching on my moat, then that I can buy. At what price does it become ludicrous? That's a conversation for the investment bankers to have. But I do think, given that logic, this makes more sense to me.
Because we know it's not movie theaters. There's an interview Matt Bellany did with Netflix is not doing it to save movie theaters. Regal CEO, I think it's Eduardo Acunha, spoke with Matt Bellany. Ted Sarandos is doing these interviews like, we're going to put movies in theaters. And the CEO of Regal came out and said, great, you have a big Narnia movie coming out that has 2 weeks on IMAX. Why not give that a longer theatrical window if you're serious about that? And so far, Netflix has just said, yeah, we'll do 2 weeks on IMAX because that's our deal with Greta Gerwig. But anyway, that's all we're doing. And for the investment people who are thinking at what price, I would say Netflix is now at about 40-ish time free cash flow, 26 times forward earnings. That's growthy, but not outer space level for a world-class company. So haven't pulled the trigger, but it's something I got my eye on. Let's move on to Davos. And I'm going to set up this clip that you have seen, and then we'll discuss it, because I think this is sort of one of the bases of the larger scale Sell America trades. And granted, a lot of the talk out of that conference was about Greenland. Seems like that's solved. We're getting some military bases there, a little bit of land, some mineral rights. I'm not an expert on Greenland. You can find that elsewhere. There's so much to unpack here. I want to take a little bit of a different angle. And I think one of the highlights of, or encapsulations of where we're at, was this when Donald Trump was insulting Emmanuel Macron and also explaining how he was trying to effectively lower the price of prescription drugs in the United States.
So when I called up Emmanuel Macron, I watched him yesterday with those beautiful sunglasses. What the hell happened? But he was at $10 for a pill. And I said, Emmanuel, and I have all the big pharmaceutical companies are in total agreement. It wasn't easy, by the way. They're tough, smart. They've been getting away with the scam for a long time. But they gave it up. But they said, you'll never get the countries to approve it. I said, why is that? Because they won't. They always said, we're not paying any more. Get the rest for the United States. So over the years, they stayed the same. We just went up, up, up. And I mean, we would pay 13, 14, 15 times more than some certain countries would. So I said, no, they'll approve it 100%. Sir, you'll never get them to approve it. I said, I guarantee you. But I actually started with Emmanuel, who probably is in the room too. And I like him. I actually like him. Hard to believe, isn't it? And I said, Emmanuel, you're going to have to lift the price of that pill to $20, maybe $30. Think of that. That means it's a doubling of prescription drugs. Might be a tripling, might be a quadrupling. It's not easy. No, Donald, I will not do that. I said, yes, you will, 100%.
So Malcolm, when you saw that clip, which I made you watch after I accidentally sent you a 12-minute clip, which I'm still sorry about, 90 seconds of that clip of Trump basically browbeating Emmanuel Macron over prescription drugs, insulting him for wearing sunglasses on stage, which was honestly hilarious. There is a root of a good idea there, which is prescription drugs are way too expensive in the United States, but also America is going at this alone as a singular power. And I think that is kind of where we're at right now.
So two things. I think, yes, that's true. The premise of the argument is true. The U.S. more than likely bears way too much of the financial burden of the cost of things like prescription drugs that everyone around the world uses. And part of the reason is because our healthcare system allows it, right? Like we force the prescription drug companies make so much money from their relationships with Medicare, a U.S. government-sponsored health insurance plan, where other countries that have more socialized medicine are able to say, you can't charge more than this because we as a country are not paying it. So our healthcare system being so crazy allows for things like this, these kind of abuses to happen. So I agree with the premise that the U.S. shouldn't be paying so much more than everyone else around the world for these drugs. That said, what you just blew past with Greenland and how absurd the U.S. approach to international relationships has been the last year. Forget previous administration, just this last year alone, undercuts the argument that you would want to make that other countries should be willing to collaborate with us and trust us to remain an ally and a partner in all of these other things. So when you say, I'm going to take this territory and there's nothing anybody can do to stop me. On the flip side, when you say, hey guys, we need to get together and collaborate so that we can help us help. Can you please help me? When you say it that way, after telling everybody I'm going to annex this country that's already been solved long ago, like it just undercuts your ability to do the thing that you want to do, where you started out the conversation talking about how I'm going to take this territory and you can't do anything to stop me.
I wasn't trying to blow past Greenland. So we're gonna do a little something for the listener here, which is I'm gonna explain scheduling. We often record this on Friday and the show comes out on Tuesday. If I start doing a lot of Greenland chatter, then anything could happen within the next 48 hours with this story. And I'm not confident that my commentary on Friday is going to be relevant on Tuesday. Prescription drugs, I think I can still make the same point about how America is trying to essentially insult and bully our allies to create better outcomes for ourselves that will end up, reverse Unoing because we don't have allies that can trust us anymore. So I thought I could do that with prescription drugs.
That's you trying to be a good journalist. This is me, just a dude with opinions.
Okay, fair enough. Well, anyway, I think the themes are still true with prescription drugs. And I want to get this does get back to the Sell America trade. And one of the most important things in that clip that I don't know if people are talking about is the fact that if you are a world leader with Trump, I don't know if you can trust that you are having a private conversation with him. Because a lot of the speech was him talking about these texts and conversations that he had with other world leaders where I don't know if they knew they were off the record. And to be clear, this is a journalism thing. Like, you want to know if you are right now. I know I'm on the record. My language might be a little different because I know I'm being recorded right now. You want to know if you are on or off the record. And that type of thing fractures trust with the United States, in addition to the Greenland thing. And what this creates, and Robert Kagan wrote about this in The Atlantic, is this move to a multipolar world. What does that mean? After World War II, the United States enjoyed a historically rare, nobody had ever seen anything like it, position where they were the singular world power, where before that you had global spheres of influence. You had the French and the Ottomans, and these different powers controlled different parts of the world. And what that created was basically more friction and more wars, because you have these, you have powers within the same weight class competing and trying to fight each other. And Kagan's point is that the United States has complained, and sometimes justifiably, that we have spent too high of a price defending the global world order. However, this is how he ends the article, and I thought it was powerful. Quote, "If Americans thought defending the liberal world order was too expensive, wait until they start paying for what comes next," end quote. And I think there are military implications for that, as you see more companies spending more and more on their own defense. We saw it with the Prime Minister of Canada, Mark Carney, basically saying, we are no longer pretending that the United States is our daddy. And if you want to come along to a place where, if you want to join us, come on, let's link up as these global middle powers. But all of that is to say, I think there's a geopolitical conversation, but also the investing conversation that we continue to have on this show, of this very real trend of short flaring stories, but also how do you respond to this move from a singular world power to these more regional global spheres of influence of, let's say, the EU, China, the United States, maybe Russia.
Yeah, I think so. We as Americans, one thing that we've always known was there. I don't want to say lurking in the shadows because it makes it sound negative, but the thing we always knew was just there to protect us was the military. So there are bases all over this country that you ride past on a regular basis and you don't even really notice or appreciate it at a certain point. At least me living here in the DC area where we've got like 4. So you knew that our military might was something you could always rely on. Secondarily, and less visible, has always been our financial might. So the rest of the world has been investing their dollars in our financial system without question, expecting that they were going to receive a payment on time, every time, and that was all they needed. So if and when we come to collect our dollars because we need it to bail ourselves out from whatever crisis we might have gotten ourselves into, the U.S. is always going to be able to make good on that payment. They're always going to be able to make good on redeeming that treasury note, treasury bill, treasury bond, whatever it is, that we've put our dollars into as smaller, mid-sized country, right? So that is a thing that we've never really had to flex before, so people didn't really know it existed. But it's also the reason that our financial crisis here in the U.S. that was caused by the U.S. housing market had ripple effects across the world, because now everybody feels it because our financial system is struggling. This is similar to that. If those countries are saying, to your point, our daddy can't manage our budget for us the way he used to be able to, we might as well take those dollars and put them in our bank account and take our chances. Well, that's the opposite of what we need to have happen as U.S. citizens. That's the opposite of what we need to happen as U.S. investors, simply because more dollars in the pool helps to shore up the pool. So the stability of our financial market, specifically our bond market, has been held up by people's unwavering belief that daddy's got it. Now that's under question, and people will say, let's find another alternative. Let's get together over here and pool our money here and make it safer for ourselves, leaving the U.S. financial system out of the equation. And that's the part that has become a problem, and I think will continue to be a longer term problem than a lot of people are willing to accept right now. Because again, we as American citizens tend to believe, to the point the article was making, for the last 80 years, we've had no reason to really question the U.S.'s ability to dominate. So it's hard to break that inertia and allow your brain to even consider this time is different.
Ooh, he did the name of the show. And granted, maybe things can change. Maybe this is a, this is a rough patch in a relationship, but it's the point you're making. America has had 3 great competitive advantages since World War II: military strength, economic might, and the underrated one is our relationships. And that is why I'm not going to justify going into Iraq, but it's why when the United States goes into went into the Iraq war, it's able to count on allies to join them. If you have let's pretend we got an issue that we actually need to go into. I don't know if you can count on your allies joining you right at this stage. You can tell that that's been fractured. How's this playing out in the investment markets? We've talked about, setting aside some allocation for maybe some more, managers who do real international funds, that you may want to pay for a manager's expertise who knows the best companies going on in Europe and Asia, that type of thing. It's also why you're seeing silver up 200% in a year, why gold continues to rise. It's why people like Oswath Damodaran have made a case for collectibles, which I think is interesting and worth more time than I'm willing to give it right now, other than saying, I don't think you can do individual collectibles as a regular person. It's a case where actually fractionalized shares might make more sense. But
Steve Golden would disagree, but
if you're in the Malcolm Ethridge school of investing, the return on effort is going to be difficult. Wait, who's going to disagree with him?
The guy from Golden Auctions that has you must not see. You don't even like Netflix.
I watched Golden Touch. Yeah.
I was saying he's going to disagree with you about fractional ownership versus individual ownership, because that keeps that platform humming. But anyway,
because he would like to collect a 30% commission or whatever on every auction that goes through. I'd rather maybe spend, I cannot own a 1986 Jordan rookie card from Fleer, but I'm more confident that will go up in value over 10 years than a base issue Spider-Man comic that I could afford right now. So anyway, I want to do this another time. We're doing it right now.
No. I was going to bring us back to the point at hand, which was Davos. Yeah. But in a less serious way, ask you, what in the world is the deal with windmills? Like,
he hates windmills.
What in the world did a windmill do to Donald Trump that's got him so fired up that he would spend 10 minutes on windmills at a World Economic Address?
I thought it was awesome. So this address makes sense, and we've talked about WWE on the show, if you understand that a lot of Trump's rise is his understanding of WWE. In the clip, he's cutting a promo saying, I like the sunglasses that Emmanuel Macron wore, and what the hell was that? Like, he's He's like setting up a wrestling match with the guy. And that's what he does with a lot of people. He also insulted Ilhan Omar, an American congresswoman, in front of a World Economic Forum. His thing with windmills, this is also a case where he is semi-right. And it's like, I need to go through and fact check. I just haven't had the time. I think he hates windmills because he had a golf course in Scotland where they were building windmills off the coast, and it disrupted the view of the golf course. And he thought they were hideous and that they weren't looking good. Now, he brings that into only stupid people buy windmills. China makes all the windmills, and they don't even have wind farms. They just have them just for show. Isn't that interesting? I don't know if that's true. What I do know is that among a lot of the renewable people, it is like the real challenge is baseload, like baseline sources of power, and windmills aren't necessarily a baseline source of power. So this isn't my area of expertise. Yeah. He is correct though. So he went on, he goes on Rogan as he's running for president, and he makes this side comment where he's like, you can't put them in the ocean. They make the whales go crazy. They go, ow, ow, ow. And he's actually right about that. Like the windmills in the ocean actually do disrupt whale communication and whale behavior. Man. I don't think that's the reason he dislikes them. So that's one of those things where I think for a lot of renewable, like Elon Musk is more bullish on solar. I think there's probably a better case for the small modular nuclear reactors, but I think it is also hilarious that he spent 10 minutes of his World Economic Forum dunking on windmills.
I was just like, what the hell is this?
Keep it coming.
Oh man. Okay. Anyway, sorry,
right,
we got a show to
do. You want to do private credit funds as we start to take this baby home?
Yeah. So I think private credit is a thing that is sold, not bought, similar to whole life insurance. It's not a thing that you woke up this morning saying you needed, but it was a thing that a dude in a nice enough suit showed up telling you that you needed and told you in such a convincing way that you said, I got to get me some of that. And I don't say that I know I'm painting with a broad brush. I don't say that to disparage the entire private credit market. I do think there's some quality opportunities, or there used to be some quality opportunities within the private credit space, but it's been so crowded out by nonsense. One, it's been pushed on retail investors because they ran out of like actual qualified long-term investors to put into these funds, because it's been a thing for like 20 years now. Once it got difficult for the banks to lend in the commercial space, private credit sprang up as an alternative to allow people to get access to the capital they need to run their businesses a lot faster and a lot easier and a lot more efficiently. Fast forward, now these funds that sold into retail so aggressively are having to gate redemptions, basically saying, you can only get 5% of your money out at a time, or 10% of your money out at a time, or whatever it is. And on a quarterly basis, you can pull these dollars out. That is the way that alternative investments have always operated. Let me say that, right? There's always been these mechanisms that say liquidity is not our number one focus. And so if you need these dollars in the next 5 to 10 years, this ain't for you. But there became this push. Retail investors should be allowed to participate. You shouldn't have to be an accredited investor. You should be able to be a mom and pop everyday investor with just $500 to invest and get access to these things too. And when we talk about democratizing anything that has been held institutionally for just the few, just the 1% of the 1% historically, now it's time to democratize it. That always sends up my ears, letting me know that somebody's about to get screwed. And in this case, what's happening is the people who really need those dollars, who didn't really understand what illiquid meant, are finding out the hard way that bringing you into the fold wasn't really doing you any favors if you were investing these dollars, expecting these bang up returns better than what the S&P 500 and the NASDAQ could get you. And it was going to be super liquid, and you could pull those dollars out tomorrow morning if you needed to.
There were times where it did outpace the S&P 500. And then once that stops, people want their money back. So I think that's interesting. And then also the term that is now on my radar is semi-liquid, which should not be a word. Liquid means speed to cash for the amount of money you like, and you can expect a like a reason you can get it out. So your house is marketable because you can sell it quickly, but you're not going to get maybe the price you want. A US Treasury is liquid because you know that you can, it's not going to drop in value if you need to sell it quickly. Malcolm, if I tell my partner that I am semi-faithful in our marriage, I don't know if she would buy that as faithful. You're either faithful or you're not. You're either liquid or you're not. This is a binary thing. Yeah. And if you're telling your people you're gating redemptions at 5% per quarter, that's not liquid anyway.
They were also sold as liquid alternatives just 5 years ago, right? So they were branded as liquid alternatives because the alternative space historically was so illiquid. And so we had to put this word on it to let people know that this is different over here. This is for you, retail investor. This is for you, non-accredited investor. This will allow you to get access and play in the space with the big boys, or whatever the commercials say that I watch on financial news throughout the day. We're going to allow you to punch above your weight, basically. You're going to outperform the S&P. To your point, it does until it doesn't. And that's the place where people start to want these redemptions. And then everybody wants out of the party at the same time, which is why it's impossible to give everybody their dollars. Because if we did, then how would we actually keep the dollars invested in the stuff that is meant to generate the returns? Ironically, though, a lot of these funds are seeing growth in assets under management at the same time that some of these mass redemptions are happening. So nobody's listening to you and me, frankly. Like, they're still wanting into the party, even though the people who want out of the party can't get out of the party.
We are over 40 minutes into the show. If you are a rare person who has made it this far and you have found value in the conversation we're having, one thing you can do that really helps the show out is rating it wherever you listen. So Spotify and Apple Podcasts are kind of the big two on that. On Apple Podcasts, if you leave a rating and then write a couple sentences about the show, hopefully if you've made it this far, you found some enjoyment in it. That really helps us out, especially as we try to grow this thing. And then Spotify, just leaving a rating or even a comment, something you enjoyed or something you'd like to hear about on a future show. I do read the comments, and I want to make sure that we are serving our listeners with informative and entertaining stuff, candy and vegetables. Let's finish up with sushi. I saw you post about this on LinkedIn. We'll do this quickly. Is your daughter's sushi habit making you broke?
Not yet.
Is that a problem?
Well, it's going to make her broke before it makes me broke. Let me say it that way. But I read that article and I was like, I understand now when people say I feel seen.
By Xavi Lieber in the Wall Street Journal about parents complaining that their children like sushi and it's too expensive.
Yeah, so the parents who introduce their kids to sushi first and foremost are the problem. In this case, I'm talking specifically about my wife, but she doesn't listen to this show, so I can say that. But I think that it's interesting that so many people in this generation who have kids that are 5, 6, 7 years old. And the comments that I got back on LinkedIn, some from my actual clients who were like, hey, me too. And I'm like, hey, let's talk cash flow. But I think that it's interesting that, I didn't experience sushi until I was an adult with a job. That is the case for a lot of people in the millennial, Xer, and obviously boomer community, because sushi didn't come to the US the way that it did until maybe like the 70s. But these kids are growing up with some very expensive tastes when it comes to food. Chicken nuggets and French fries from McDonald's were a huge deal for me. It was a Friday treat. It was a you got a good report card treat. It was a, I finally wore my mom down driving home from school one day and she gave in and bought the $2 Happy Meal. Like, that was a big deal for me. Meanwhile, these kids are dining out on raw fish and probably have great apple juice pairings to go with it.
So the chef and owner of Shumi, a sushi restaurant with 2 New Jersey locations, David Seo, said that his restaurants are now packed between 4 and 7 p.m. with families paying almost $100 a head to eat 15 sushi pieces. And he said the parents say it's a reward for finishing homework.
That's crazy.
I think this is hilarious, but it's also a larger economic trend. Sushi is booming, and right in the mid 20th century, you're worried about food foodborne illnesses. How long has that fish been sitting out? There is a lack of trust that has been overcome with really good supply chains, excellent cold chains, and a lack of foodborne illness breakouts. And in the case of Kroger, which I think is the largest seller of sushi in the United States, they sell 1 million rolls per day now. And it's up 50% since 2019. It is a move to health. It's a grab and go snack. If you just get a couple of rolls, it's not super expensive. And then I was looking into this because I've noticed this as well. People love sushi. This is a business that's booming. And there's only one publicly traded sushi restaurant chain in the United States. Yeah. It's called Kura Sushi USA. And they are the largest chain in Japan as well. So they have a Japanese ticker and they have an American ticker. I think the American ticker, though, is just the United States locations. And I'm seeing this. I'm like, parents are bringing their kids to eat sushi. Gen Z, Gen Alpha loves sushi. This boom is going to continue throughout my life. Maybe there's an investable angle here. And then I look at this company. I'm like, all right, an insider just sold $700,000 worth of stock. It doesn't look like, and it didn't say option execute next to it on the NASDAQ page. The reviews of the restaurants near me of this chain, 4.2 stars, which isn't great. And then the comp traffic is also down. So they're like, we're going to make more money because we're opening locations. However, we can't get more people into our existing locations. And I saw that and I'm like, you have every generational force wind at your back and we're not getting more people in the door. So,
well, we are in the middle of an affordability crisis. So maybe the first thing to go on your list of where do we dine out is the $100 per head sushi versus the other things.
No, they're saying the 100. This is the K-shaped economy.
Yeah, that's true.
The omakase is fine. Maybe it's the mid-level sushi restaurants that are suffering.
I guess there are K-shaped kids out there too. That's a fair point.
However, I would say to those listening who made it at the end, I do have ballin' on a budget sushi tips that I want to share to close out the show. Some practical advice.
Kroger wasn't the ballin' on a budget sushi tip.
You can do better. Oh. If your daughter is breaking your bank, Malcolm, I have 2 suggestions. Number 1. Uber Eats has a lot of sushi deals that you can combine with BOGO. So they'll often do like a, I don't know if this helps the restaurant. Uber will give you like a 30 to 50% off promo. And then there's sushi restaurants that will do buy one, get one free offers. And so Sam and I did it. And it was like, we got a bunch of rolls of sushi that should have been $150 or whatever. And it was like close to 60, I think. Was the quality great? It was all right.
Yeah, see, that's part of it too. But
if you're just getting like a spicy tuna roll and some like basic stuff, you can be okay.
No, dude, it's the experience. It's like the new hibachi. There's a place here in DC, really close to my office where I'm sitting, that like will come and torch the Wagyu beef on top of the sushi roll, and you can watch the whole thing as they do it for like 60 seconds. Like it's the experience is part of it.
Okay, then make it yourself. That's the experience.
Well, you got to spend 10 years washing rice before a sushi chef is willing to let you come next to them and learn anything.
All right. No, you don't. This is gatekeeping. This has been the ultimate gatekeeping move. You can absolutely make sushi yourself. I looked it up. You do have Japanese markets in Washington, D.C. You can go to one. You can buy the fish. You buy sushi rice, and then you got to season it, which is not that hard. I'm not listing the recipe right now. Rice, vinegar, sugar, salt. You'll figure out the proportions. You make the rice, and then you cut the fish, and you're getting meatier chunks. Yeah. And once you go to making your own sushi, you will be disappointed at most sushi experiences you have, because you will go, I don't cut the salmon that thin. I want some thick sushi fish right now. That's not the way I make it. And you can get this. You can get the salmon at Whole Foods or Costco. Cure it a little bit, freeze it is what I'm supposed to tell you, but it can be done, and you shouldn't only I don't think you should only rely on someone who has learned rice making for the past 5 years to do it.
Fair enough.
All right, let's leave it there. I'm Ricky Mulvey on LinkedIn, at Rick So Slick on X. Malcolm is Malcolm on Money on social media platforms. Thanks for listening. We will see you next week.
information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.